looking at what the S&P has done over the past 3, 5, 10 years, just an exceptional outcome by its own history. I know history in any markets. But we end up now with an index that is extremely concentrated. I mean, it is no longer, you look at it and it's called the S&P 500. It gives you this notion of a diversified portfolio. But the truth is, the top 10 stocks are now 40%. 4 out of 10, 40% is only the top 10 names out of 500. An extraordinary level of concentration.
Has it ever been like that before?
It's never been like that before. It got close to that in the .com bubble. So it's actually worse now. And it's the same thing can be said about the MSCI World Index. It's obviously a bigger, more broad index. But again, exceptional level of concentration by its own history. We haven't seen this. And not only do you have concentration in terms of the names, but we also have extreme concentration in terms of how narrow the returns are. So a small number of names are dominating the index, and they're even dominating the return profile by even more. So the index, what it looks like it's a diversified index, by weight, it's extremely undiversified. And by return, it's basically all coming from a handful of names.
And we haven't seen that really since the lead up to .com.
Well, essentially in the past 200 years, we've got 2 instances where this has happened, the .com bubble in the late 60s.
And it seems similar with valuations as well.
Yeah.
You know, valuations are at all-time highs. The Cape P is at something 37. Forward P is at 23. What's really frightening is the risk premium. So that is the earnings yield of a stock minus the treasury. You know, that's negative.
Yeah.
So the market seemed to be pricing in no risk. And again, what have the returns been whenever that's been the case?
Well, the last 2 times, again, this has happened twice in the past 100 years. And you had the last decade on U.S. equities when that's happened. And even if you broaden your view and look at instances like that in other equity markets, so we're not looking at only 2, again, consistently, we see this time and time again. You end up with that situation, you end up with a lost decade. In some extreme cases like Japan, you end up with several lost decades. So whenever that's happened, it did not end well.
But that's for the index. That's not for the stocks.
No, obviously, as we were saying earlier, the index is very concentrated in these names. And so when they come down, they can bring down the performance of the index. But the funny thing is, and we've seen this in 99, for example, 98, 99, all of the money left kind of old economy stocks and went into the .com and tech names at the time. And so these companies, great quality businesses, continued to do well. Fundamentally as businesses, but their stock prices were actually cheap. And so when that reversed and tech names went down, these kind of boring companies essentially went up in price. So you can have a situation in this scenario, and this is exactly what happened the last 2 times we found ourselves in this position, where the index goes down, but the average stock in the index goes up, because the average stock has gone nowhere for 2 or 3 years. It's the index being driven by a handful of names. Yes. And I think that's what's going to happen again.
I think so. There are a lot of parallels that we're seeing between, you know, what's happening now and what happened, you know, especially 98, 99, 2000. You know, when we look at US valuations to non-US valuations, when we look at the discount of small caps to large caps, or value to growth, you know, the discounts have never been quite so wide. The only time we've seen it is .com. But also there are a few other things that we're looking at. You know, when you look at US household exposure to equities, that's at an all-time high. US consumer confidence in equities is at an all-time high. Yeah. I know that sounds positive, but it's not because yeah. Now their exposure is at an all-time high. They've got no more capital left to deploy. Yeah. So this is where sort of bull markets run out of steam, when there's no more buyers left. Mm-hmm. Mm-hmm. You know, so, you know, I can't help but worry that, you know, again, like .com, which supposedly was triggered by the rising interest rates, but we've seen that happen, you know, recently, and we're seeing more inflationary pressures in the US, you know, which could be coming.
I think it's impossible to exactly time these things, but Sadly. The indicators are certainly that we're really getting close to that line. And whether it's, I mean, 1 month or 6 months or 12 months or whatever it might be, we're definitely in the last innings innings of that game. I don't think there's a lot left to go.
No, I think you're right. And, I don't know what will crack it, what will be the things cracked, but my suspicion might be that it could be one of its great poster childs of this bubble, which would be NVIDIA.
Yeah, I think in retrospect, we'll have a good answer to this question, but with the benefit of hindsight. But I think for now, I think it's very clear that we're getting to a situation that is unsustainable for tech names, unsustainable for the index, but at the same time presents this exceptional opportunity if you're focusing on the things that are at an all-time high, all-time low in terms of cheapness or extreme outcome in terms of cheapness. So quality, value, non-US, really, really cheap relative to US and tech overall, and should do well over the next several years.